Welcome to chapter 13. What is financial risk? There are three main objectives in this chapter. The first objective is to understand what is risk versus reward. And the second objective is what is the baseline value for risk and reward. And the third objective is what causes financial risks in a business. So let's get started. I'm sure everyone has heard before risk versus reward. And so I have this little picture here to kind of demonstrate and something to kind of think about as you take on a more risky investment. On the left, we have marginal amount of risk and reward on the bar as the person is walking the tightrope. And over on the right hand side, you can see that the person has taken on more risk for more reward. And what the result is that the person has more pressure and more stress, and you can see how his tightrope is arching and bending there. And if he makes one little mistake as he is walking, it's going to be a total collapse of his investment. So kind of keep that in mind as you assess your risk versus reward. And so we know our risk whenever we are investing in stocks and bonds is that you could lose a little bit or all of your money, and the reward is that you could make money and not really have to work for it very hard. So when we look at our tolerance of risk, over on the left hand side on the screen, you see number one, which would be our lowest amount of risk for the reward, is going to be our 10-year federal note. What that is a bond, but it is 10-year bond. Whenever you have something that's shortened in term, it's actually called a note. So if you are talking 30 years, then it would be called a bond. And then on the right, we have a funny picture with a Ponzi scheme incorporation or a company with highest risk of 10. So as you look at this chart, what you are going to have to do is you are going to have a assess and think about the amount of risk that you are willing to assume for each and every investment, and you are always going to compare it back to the 10-year federal note. Now, the reason that we use the 10-year federal note is because the federal government can simply print more money in order to meet that obligation. And if you're going to take just simple cash, and let's just say you held $100 in cash for a 10-year period, that federal note is always going to outperform just the cash because you are going to be making 3.53% yield as of 1st May 2023 on that federal note, whereas the cash should be making absolutely nothing. So regardless of how inflation moves in the future, you are still going to be doing better with that federal note. And that's why we are going to use that as our benchmark to compare it to any other investment and the risk that's associated with any other investment. So, what causes financial risk in an investment? We have three risks that we are going to be talking about. The first risk that we are going to talk about is the debt. When you start talking about stocks and bonds, it doesn't matter either one of those investments. But if the company or the local government has a lot of debt, there is an enormous risk to you as the owner of that company or as the person giving loan to that company. So, when you look at why a company incurs debt, the reason that a company takes on debt is because they want to speed up time. That's all there is. It is an instrument of speeding up time. If you think about in these terms, like if a person is going to go out and buy a $300,000 house and they are going to take out a loan in order to buy it, the reason that they are taking out that loan and incurring debt is because they want to speed up time. They don't want to wait 15 to 20 years in order to save up enough money to buy that home. Instead, they are going to take off the debt and they are going to go ahead and speed up time so they can move into the house right now. So, when you talk about a business, it's exactly the same thing. A company incurs a lot of debt or takes on debt because they want to speed up time. They want to have that machine in order to make that product today, and they don't want to have to wait 5 years in order to save up enough money to buy that machine. So you might be thinking, why is that bad? So I might have a little bit of a silly example here, but I'm going to use it anyway to kind of maybe symbolically represent what's happening here. Let's assume that we are playing a video game. You have 30 seconds to shoot a little rat that's running across the screen. On the far left, we are going to start off with a normal speed. And let's say that in the 30 seconds, 10 rats run across the screen. And since the rats are moving in the normal speed, you are good at the game and you can kill all 10 rats. As we speed up the speed of the rat, but we still have 30 seconds to shoot as many as we can. We actually had 14 targets that ran across the screen and we were able to shoot 12 of them, which was a little bit better than the normal speed. And then as we speed up the time, we have 18 rats in 30 seconds. And we now only kill 10 because the rats run it faster and it's harder to shoot. And then we go to a very high speed and we have 22 rats that run across in 30 seconds. But we were only able to kill 6 because the rats were moving so fast and it was really hard to shoot them. So in this silly example, we have the rat and the speed is representing the amount of debt that a company is taking on. So as the company is taking on more debt, the company is actually becoming less productive in the long run. And as you can see, with a little bit of debt and a manageable amount of debt, which would be the rat just gradually running a little faster, the company actually performed a little bit better. And so that's something that you need to think about. If a company has debt, that's fine. If a company has a lot of debt, that's not fine because that's putting a lot of risk on you as an investor. And it's always ends bad whenever you're investing in a companies that incur a lot of debt. So you can maybe use this silly little example to remember that as you look at your companies and you see a company that's incurring a lot of debt, that's the company you want to stay away from. They are becoming less productive instead of just sticking to that normal speed and even maybe just going a little bit faster with a little bit of depth. So here is what great investors like Charlie Munger and Warren Buffett's opinion on debt. Only when the tide goes out, you discover who has been swimming naked. And what they mean by this is the people who are out there swimming naked are the people who have a lot of debt. And when the tide goes out, which means that the market collapses, that's when you truly figure out who has been swimming naked. Because those are the people that don't make it, those are the companies that fail. So let's talk about our second risk. The second risk that you have as an investor is overpaying for an investment. So Charlie Munger and Warren Buffett's opinion on this is that the price is what you pay, the value is what you get. So let me give you an example. Let's assume that this man on the screen here goes and sees this beautiful home. It's very beautiful, and he sees that the house is on the market for $500,000. But he likes this house so much, it's just absolutely gorgeous. It's his dream home that he is willing to pay $80,000 over the listing price for the house. So 1 year later, after this man paid $580,000 for this house, he has to sell the house because he is going to be moving for a new job. So he is trying to sell the house and he can't get anywhere near the price that he paid 1 year earlier, and that obviously comes as no surprise. So what we have to look at is that the house was still a great house. Nothing changed about this house. He still maintained it. He took care of it. Something else that didn't change was the market condition. So when we look at this, the poor investment was based off of the initial price paid and not the quality of the home. The home was beautiful. It was great, but the investor paid way too much for the house, and that's why it was a poor investment. So when we look at how this investor overpaid for this house, and he paid $580,000 for something that's worth $500,000. How is that any different than a person in the stock market buying a stock for $58 when it's only worth $50? And what I tell you is there is absolutely no difference. That ratio 500,000 to 580,000 is exactly the same as paying $58 for something that's worth 50. And that's what Charlie Munger, Warren Buffett means. And that's our second risk. Price is what you pay, and the value is what you get. Okay. And the third risk associated with owning investment is that risk comes from not knowing what you are doing. It's that simple. So when you looked at the last example, why do people value the ownership of a house but not value the ownership of a company? What it comes down to is, on the left, people understand that they understand the value of the home, but when you look at the right, they don't understand the value of the company. And they definitely don't understand the value of the company when you break it down into individual shares that are broken up into 10 million pieces of shares. And so that is the true risk here. And if you are the type of a person that may be out there buying companies and buying shares and you never look at what they are worth and you are just buying on based off of, or like, I like this company, you are probably setting up yourself up for buying the $580,000 house, even though it's worth $500,000. And this is what Charlie Munger and Warren Buffett really means. Risk comes from not knowing what you are doing. So let's recap our three risks. The first one is excessive debt. You want to stay away from those companies. A little debt is okay, but a lot of debt is always going to get you in trouble. Second one is overpaying for an investment. You have got to know what the value of an investment is before you buy, or else you are going to be the person out there buying that $580,000 home. And the third one is not knowing what you are doing. So, just a quick recap. In the follow on lessons, in the follow on chapters, as we continue forward, we are always going to be comparing the value of our stocks and our bonds back to the 10-year federal note. So it might not make sense right now, but as we continue on to the follow on lessons, it will all start becoming clear. So that completes the chapter 13. What is financial risk? We learned about risk versus reward. We learned what is the baseline value for a risk and reward. And we learned what causes financial risk in a business. And I hope you guys enjoyed the lesson. And I will see you in the next chapter.